Welcome everyone to Martiak Market Update with your host Mark Martiak. Mark is a Managing Director of Investments with AGP, Alliance Global Partners, member of FINRA and SIPC. This show will explore topics ranging from market updates to the global economy and personal finance. Money is knowledge, and Mark wants to help you navigate your relationship with money by offering timely guidance and his unique perspective. Here's Mark Martiak.
I'm Mark Martiak, and this is the Martiak Market Update. Welcome back, and thank you for joining me as we discuss key trends shaping our industries and markets. Today, I'd like to dive a little deeper into why we are experiencing a red-hot IPO market. Initial public offering shares are typically sold to institutional and retail investors. A company will traditionally work with one or more investment banks on the process, as well as listing their shares on one or more of the stock exchanges. To give you an idea of where the U.S. IPO market currently stands, in 2020 there were 218 IPOs, the most since 2014. As of September 2021, we've already witnessed a record 279 IPOs price this year. So why are so many companies going public? Several key factors are contributing to the creation of this near-perfect environment. First are low interest rates. According to Matt Kennedy, a senior strategist at the IPO research firm Renaissance Capital, and I quote, "Low interest rates have pushed up valuations for growth companies, and the hundreds of unicorns in the pipeline are looking to take advantage of that. We're seeing companies that both benefited from the pandemic as well as companies that are pitching post-pandemic stories," end quote. Many of the IPOs launched this year have been SPACs, special purpose acquisition companies. SPACs are publicly traded companies created with the aim of acquiring or merging with an existing company. SPACs have become popular alternatives to traditional IPOs, in part because companies combining with them can typically make business projections. Several factors are responsible for the recent boost in shares after a SPAC deal closes. Large investor withdrawals reduce the number of shares available to trade, which is known as a stock's float. That scarcity means it doesn't take much to swing the stock. Companies that go public via SPACs are also popular targets for short sellers who wager on stock price declines, a trend that attracts day traders hoping to squeeze the professionals by bidding up the shares. The stock market continues to reach all-time highs, and there is significant liquidity in the markets. This has been driven by a combination of government stimulus programs over the past year, strong corporate earnings, and a flush of venture capital cash. Third, the pandemic has accelerated the digital transformation process for companies. To remain competitive and support a dynamic workforce, companies need to adopt new technologies. Think of things like cloud computing, information security, artificial intelligence, and collaboration tools. This push has resulted in an extremely active technology sector IPO market. Lastly, retail investors now have more access to IPOs than ever before. Traditionally, IPOs have been accessible to employees and institutional investors. However, online brokerages like Robinhood are providing retail investors with access to own a piece of their favorite company. Younger investors are also entering the market looking for high-growth opportunities like IPOs. If you want to get involved in purchasing shares of a company that is going public, I have some advice. Be cautious. For every high-profile IPO that may double on its first day, there are countless new stocks that will disappoint. It's also hard to know which IPOs will succeed. Many tend to be newer companies with a shorter track record and unproven leadership. Pay attention to the warning signs. The more uncertain the outlook, the riskier and more volatile the stock tends to be. You can afford to be choosy. With so many companies going public, you have the luxury of doing research and speaking with professionals to determine which companies to invest in that will best match your investment strategy. If you are unable to get the shares you want at the offering price, avoid purchasing stock on its first day of trading. Wait and see if the company performs at its next earnings announcement. And if you still feel strongly about the company, wait to buy the stock on a dip. We'll likely see the IPO momentum continue for the remainder of this year, driven by sectors like technology and healthcare that have been resilient throughout the pandemic. The strong IPO market we're currently experiencing is a good indication the economy is recovering from the pandemic. However, it's still a good idea to be cautious. We are not out of the woods as it relates to the pandemic, and anyone like me who has been investing in the market for decades knows a hot IPO market can dry up in an instant. If you want to discuss which factors you should consider before investing in an IPO, please reach me directly by email at mmartiak@allianceg.com. Thank you for joining me. It's been fun. I'll see you the next time when we discuss some equity compensation strategies.
Thank you for listening to Martiak Market Update. Mark Martiak is the executive producer. Sean Dooley is producer, and Jennifer Gray is consulting producer and content editor. We also want to thank Libby Grant. If you enjoyed this episode, subscribe and leave us a review on Apple, Spotify, or wherever you listen to your podcasts. Stay tuned for Mark's next episode coming soon.